Yo, I'm Brendan, and today we're going to talk about how to invest your first $1,000. Maybe you're young, you got your first job, you want to get the ball rolling with investing. Maybe you're older. Maybe you're as old as me and you're just getting started on this investing kind of game, but it's not totally clear what to do and how to get your first $1,000 rolling. So today we're going to go step by step covering the basics of how you get started investing. And specifically what we're talking about here is not real estate investing. We're not buying like limited edition Nikes or Pokemon cards or things like that. Specifically, we're talking about stock market investing. Why stock market investing? The beauty of the stock market is you get really good returns and do no work on your end. Almost everything else requires some kind of expertise to know how to buy into that asset, knowing how to flip real estate or buy at the right time or in the right market. Basically, every other industry that you might invest in has this huge learning curve, and the stock market just requires that you invest in a reasonable way in an account that helps you out and then do nothing for the rest of your life, essentially. So it's very, very passive. I'd say of all the kinds of investing that I know of, it is the most passive. It requires the least amount of skill and expertise, and that's why I love it. So let's get started. How do we get our first $1,000 rolling? To start off with, you don't even actually need $1,000 to get started investing. Maybe you've saved up $1,000, and that's really cool, but you could get started with a lot less. You could start with $50 or $100 or something like that, because most investing platforms don't have a minimum like maybe they used to 20, 30, 40 years ago. The world of investing has become a lot more friendly to people like you and me, and that means less account minimums. So it's really cool. The first thing we have to pick is who we're going to actually invest with. We've got to find a company that will give us access to the stock market, if you will, because you can't just put money directly into the stock market. You need like a middleman. You need an investing brokerage, it's called. And there's a bunch of good options for you nowadays. I really like a few that I think are really handy for beginners. And the one that I recommend most often is Acorns. The only problem with Acorns is that it costs a monthly fee. Acorns is $3, $6, or $12 per month. And the reason it could be worth it for you is if the stock market in general feels very scary and you want it to be as hands-off as possible. Like, let me just send the money in there, do nothing else, learn nothing else. I don't want to have to pick anything out in particular. I think for a lot of people, that's a legitimately good option. And the fact that this is a flat fee makes it totally doable in my mind. In my opinion, the kind of fees that we want to avoid are a percentage fee. What that means is a chunk of whatever money you have in there is always going to be paid to the investing brokerage. And if you have a lot of money over time that you put in there, they're going to be taking a lot of money out because it's a percentage of the total. What it looks like to invest with them is you start an account, you sign up with your email, you answer a few questions about how you want to invest, and then you put money in it. Nothing else required of you. Another popular option for beginners, because it's still relatively simple, not as simple as Acorns, is Robinhood. Now, Robinhood doesn't charge you a monthly fee to use their service, so you could actually do this with minimal dollars up front, start an account, send in a few dollars, pick what you want to invest in specifically, and you're off to the races. I think Robinhood is good for you if you really don't want to pay that monthly fee, or if you know that you kind of want to invest in this particular ETF or this kind of investment. Maybe I just lost you because I used a term called ETF and you don't know what that is yet. That's fine. We're going to answer that in like 5 minutes. The only downside to something like Robinhood is that it forces you to actually pick what you're investing in. If that's really scary, go back to Acorns. A couple more decent options that I think are worth mentioning. Public is pretty easy to use. They don't have any upfront fees or anything like that. And a lot of people like the structure of M1 Finance too. So I feel like amongst those four, you can find an investing brokerage that you want to invest with. The next thing that we have to choose after we've picked an investing brokerage is the kind of investing account that we're going to use to invest our money in. Now, I feel pretty strongly about this. If you're just dipping your toe in the water for the first time, if you don't know necessarily if you're going to be investing for a really long time and how this money is going to play out, I think we need to keep our options open. If you do something like a taxable brokerage account, it's called, all that means is there's basically no rules around this thing. You can put money in when you want, you can take money out when you want. You're not going to get any big tax savings for using this account, but it leaves you with the option to pull money in and out as you please. Now, just a word of warning there. Typically, the people who put money in and out of the stock market rapidly and often get worse returns than somebody who puts money in and then leaves it there for a long time. So you don't want to plan on doing that necessarily, to be putting money in and taking money out. It almost guarantees that it's going to negate the value of you investing in the first place. But a taxable brokerage account is nice just because it's simple. There's no real rules around it that you have to know. So I'd say probably for 75% of people, that's the right account type to move forward with. If you're open to leaving the money in there for a longer amount of time, having a little bit more rules, and setting yourself up for retirement, an IRA account is a really good option for you. An IRA is a kind of account that is built for you to save for retirement, i.e. between now and when you're in your early to mid 60s. The reason that you would use that kind of account instead of a taxable brokerage is that you get tax savings on it. So depending on the kind that you pick, you either save money on taxes this year or you save money on taxes in the future whenever you withdraw the money. But in theory, at least, you should have more money in your pocket at retirement if you use an IRA as compared to a taxable brokerage. It just requires some discipline and some planning in between now and then to say, all right, this money is in the IRA. I'm not going to touch it. We're basically trying to leave it alone for the 10, 20, 30, 40 years between now and when you're in your mid 60s. And if you can do that, I think it's worth it. I think it's a very powerful account type. I think it's for sure worth using as long as you can leave the money alone. So you've chosen an investing brokerage. You've chosen an account type, either a taxable brokerage or an IRA probably. So once you have a login with the company, they'll probably ask you what kind of account you want to open. You follow those steps according to their website. It's going to be different for everybody, so there's no use in me telling you exactly how to do it because Robinhood looks different than M1 Finance, looks different than Public. But you basically click agree and next a bunch of times until you have the account type that you want open, and then we send some money in there. And the way that you do that is you link your current bank account with this investing account. A lot of investing brokerages do that completely digitally nowadays with a company called Stripe. And so you basically will be on your investing brokerage account website and it'll say, hey, do you want to transfer money in or do you want to contribute? All that means the same thing. You say yes, it says, hey, you can link your bank account. Okay, great. And then it'll have you log in with your bank account credentials, like your name and password for your checking and savings account bank. And what you're doing is you're building a bridge between those two financial institutions. So you're saying, like for us, we still use Wells Fargo, even though I think they suck. Hey, Wells Fargo, I want you to connect with Robinhood, or I want you to connect with Acorns. But then once you want to send the money over, it's slow. Just going to forewarn you, for most investing accounts, the actual transfer process takes like 3 to 5 business days. That's just how slow money moves. Nothing is wrong. Nothing is, going haywire for you. It just is kind of a slow setup. So if I said, hey, I want to open an Acorns taxable brokerage account, $3 per month, no problem. Link it to my Wells Fargo. Let's put in $1,000 to start. Go. Then it's going to feel like radio silence for a little while. But once those 3 to 5 business days are up and the money's actually hit the account, if you're using a service like Acorns, you're done. It's invested the money for you. There's no other decisions to make. You're off to the races. But if you're not using an investing service like Acorns, now you have a whole nother step that's going to happen. Like let's say you're using Robinhood, for example. You'll have something like this on your screen that says buying power. For us, we've got individual cash of $10,553 in here right now. That means that this cash is sitting here in a waiting room of sorts, waiting for me to deploy it into an investment. We have not invested the money yet. This will be the same process with most other investing brokerages you choose, with M1 Finance, with Public, with Vanguard. Basically, everybody but a turnkey service like Acorns is going to have this sort of waiting room situation. And that's because they're waiting for you to make the decision. Where do you want to invest the money? There's about 10,000 different ways that you can invest it. So you've got to pick one. If that individual cash section or that buying power section still says 0, it just means the cash hasn't landed yet. So you probably need to wait a couple more days. But once you actually have a cash balance here to do something with, to invest with, now it's time to get off to the races and pick something specifically that you want to invest in. Now, if that's a little bit scary to you, one good thing about a lot of these accounts, if not most of them, is the cash that you have in there that's not invested yet. Just get familiar with that term. Cash means not invested. It means it's just sitting there in the form of dollars and cents. It's not really working for you yet, but a lot of these companies do have a cash sweep program or kind of a high yield savings program where the cash that's sitting there that's not invested is actually earning you interest, which is really cool. So for me right now, because I'm paying for the premium version of Robinhood, Robinhood Gold, I'm getting 4.5% interest on my uninvested cash, which in some years is a pretty good investment return in and of itself. The reason we would invest is we want more than that. But as it's sitting here in this waiting room, it's still growing, which is really cool. But if we want to deploy that money, invest it, and have it grow a lot more than that in the future, we've got to pick an investment now. How do we go about picking the right kind of investment for us based on our goals and our kind of investing style? Well, I'm going to say that you have 2 to 3 different kind of avenues to go down. The first avenue to go down is an extremely popular one, and it's called picking companies you've heard of or picking companies that make products that you really like. Well, I've got an Apple computer here. Let's invest in Apple. Oh, I've got a Logitech mouse, actually 2 Logitech mice. Maybe we should find the Logitech company or whoever the parent company is that owns Logitech and invest in them. I mean, that's definitely a strategy. It doesn't mean that it's a good company to invest in. Just because you like the thing they make or your buddy has mentioned them as something that he's invested in, it doesn't mean it's a good investment for you today, but a ton of people do this. They just pick the big names. Oh, we're going to do NVIDIA, Apple, Tesla, Facebook, and some other random company that your Uncle Larry told you about, and that's going to be your investing style. It's basically haphazard, it's gambling, it's speculation, it's kind of directionless and pointless, but technically you are investing. You're probably going to lose, if not literally lose money. You'll probably break even and not make this even worth your while. So by the numbers, statistically, the people that invest in that way, the vast majority of us do very badly. Yeah, there's like 1 or 2% who win big because they found out about NVIDIA 6 years ago before they blew up, but we can't count on those results happening for us. It's a foolish way to invest. You may as well go to the casino and put it all on black and hope for the best. A potentially wiser way for us to invest, even though this is not investing advice, is to pick something that diversifies your money, that spreads out your money across hundreds or thousands of companies so that you don't have so much risk tied to one or two. Yeah, Apple has made really great products. They've been the most profitable company in the world. But do I know that 10 years from now they're going to keep doing that? No. So why would I put all my money in Apple? Why wouldn't I spread it across 100 different companies so that even if Apple does badly, my other 99 companies have a chance of propping up my investments, of making it work, right? The way that you invest across a bunch of different companies like that is through what are called index funds or ETFs. ETF just stands for exchange traded fund. Think of it basically the same way as an index fund. There are very small differences between them, but if you're doing your very first investment, don't worry about the differences. The point is that through these index funds or ETFs, you can get exposure to a whole big chunk of companies. Like maybe you really want to do tech companies. You can find an index fund that's just tech companies. Or maybe for some reason, you've got a really good feeling about commodities. That's an industry that are called commodities, or real estate or healthcare or whatever. Excuse me, I just whacked my microphone. You can pick one that invests in those things. Now, if you're like me and you don't have a strong belief about any one of those particular sectors doing really well compared to the other ones, you can do what's called total stock market investing. And these kinds of funds take a little bit of each company in the entire stock market and you invest in them despite the amount of money that you have. If you're going to walk up to the front door of like GE or some giant company, Facebook, and say, hey, I want to invest in you. A, they probably wouldn't take private investors right now. And B, if they did, you'd probably have to have $1 billion. The amazing thing about the stock market is you can say, hey, I want to own a tiny piece of every company in the stock market, and all I've got is $100. And you can do that. It's a tiny, tiny fraction, but technically you are exposed to all of those, which is a good thing. Exposed is typically not a very nice word, is it? In this case, exposed means you are part owner in all of that, and you get to receive the benefits of their growth over time. You also are on the hook if they go down, but the point of picking the whole stock market is overall, we're thinking, assuming, hoping that the kind of American growth engine that thus far has proved to be a big growth engine for the last 100 years continues on in the future, that we continue to add value to the world, that we are profitable, that we help people, and that is reflected in the value of these companies going up over time. This is primarily the way I've been investing for my life thus far, and it's worked really well for the last 15 years. Can I know for certain that it's going to keep working for the rest of my life? Absolutely not. None of this is a certain thing. But in contrast to this, what other options do we have? You can keep your money in cash, like literally in dollar bills in your hand. And because the price of everything in life is going up, it's known as inflation, that means the value of the money in your hand is going down. So you're losing money if you're holding on to cash. As we started the video, you could invest in real estate, in Rolexes, in high-end cars or something else, but you've got to be an industry expert to win at that too. And so everything that we invest in is a risk and a gamble to some degree to try and figure out what's going to happen in the future. For me, I have enough faith in the stock market, in American industry as a whole going forward, that we've put a bunch of our eggs in this one basket. And so hopefully for all of us, it works out, but that's essentially what we're counting on whenever we invest this way. So we've talked about kind of day trading, picking stocks, doing that very risky thing, taking advice from your coworkers and your Uncle Larry and that kind of thing. That's investing method number one. Number two is stock market index funds or ETFs that give you exposure to hundreds or thousands of companies all at the same time. A third way is a way that's offered by some investing brokerages, not all, but some of them offer a kind of like suggested investing path, or they'll have a kind of let's hold your hand as we invest together kind of a thing. Vanguard does this. I think WeBull does this. Robinhood conspicuously does not do this. I don't remember if Public does this or not. I think they do. Let me look. Oh yeah, here we go. Automate your investing strategy. So you can kind of pick a risk level, like how risky you are or not. You can pick a theme, like you want to invest in AI stuff or climate change or whatever. You can invest in just America or Asia or Latin America or something like that. So, and the reason you would do this is you want a little bit more direction than you just picking something totally for yourself. It's kind of tricky to know which exact index fund or ETF or company do I want to pick? And so if your investing brokerage has something like an automated plan or investing themes, or like with M1 Finance, it looks like suggested pies, like they'll have expertly built pies that you can jump into and say, hey, somebody else has developed this mix of ETFs and stuff. Seems reasonable enough to me. I'll jump into that so I don't have to specifically pick them. And those are pretty cool because they kind of span the gap between you picking everything and you being totally hands off like Acorns is. They're kind of right there in the middle where, you're still in control, but you're picking someone else's sort of formula, if you will. A lot of times investing services don't charge extra for that kind of thing. It's sort of a pre-built theme, it's like a formula to follow. And so there's no one to pay to have access to that. Some other ones do. So be aware of that. Just read the fine print, see if it charges a percentage or charges a dollar fee or whatever to do that kind of thing. And that kind of marries into a whole nother way that you can invest, which is literally paying an advisor to invest the money for you. On the whole, I'm pretty opposed to that because I don't think that they're going to add any more value than you could add for yourself just by picking an index fund. But especially if you're somebody who's just getting started with your first $1,000, you really don't need to go down that road. Advisors are very expensive. They typically charge a percentage of all the money that you have. They typically get you worse returns than if you just did index fund investing on your own. And so I typically steer very far away from them, but you can do what you want. This is your life and your money. Okay, so now at this point, you've chosen the investing company you want to go with, chosen the specific kind of investing account you want, either a taxable brokerage or some kind of IRA, either a Roth or traditional IRA. If you don't know the difference between those, you can watch my IRA video that I'll link at the end of this video so that you can kind of clear that up. Then if you've chosen your account type and you've moved forward with transferring money into it, then if you're using Acorns, then it's totally automated. The money's invested, you're done. If you're not using Acorns, now you've had to choose the specific kind of investment that you want. Do you want to day trade some stocks? Do you want to pick an index fund here or there? Do you want to have some kind of automated investing plan like Public and others offer? And then once you do that, and the money goes from cash to actually invested in an investment, there's really nothing left to do. You sit around, hopefully your account value goes up over the course of a year or two, but I really don't look at investing results in any span under a year. Somebody like Robinhood kind of defaults to this today view. Is that really helpful for us? Do I need to know what's happening today and all these little moves up and down like little baby mountains and valleys? No, it's not really telling me anything that's going to inform my life and help me to make a better decision. Even a 1 month view. Okay, it's gone up 1.74% in 1 month. So? Normally if you say 1% of something in common conversation, that seems like such a small amount. Now, technically a 1% gain per month is amazing. That's fantastic. But again, does that help me? Does it tell me, oh, I'm doing the right thing or the wrong thing? Not really. Even a year to date view, 15%. Okay. 1 year view, almost 19%. I mean, that's great. You want the chart to be green and going up and to the left. That's a good thing for us. But if we're doing the kind of passive investing that I'm talking about, where you set the money in there, you forget about it, you let it grow over time, we don't really even need to see this. At this point, now that you've had the investing account set up, you've chosen the kind of thing you want to do in the account you want to do it in, now the game is earn as much money as you can and invest as much money as you can. Because your first $1,000 is just the start. For us to have enough money to have passive income to retire on, or just have a big lump of money in terms of a nest egg to be able to retire or buy a house or do anything big with, we need to invest a lot of money. We've got to put in money up front so that it can snowball well. Now, I'm not claiming that more money grows faster than a small amount of money, because your percentage growth here, like my 18.92% from this year, wouldn't be any different if I'd invested $10 or if I'd invested $30,000. The rate is the same. The difference is that when you're making 18% on $35,000 invested, well, your growth is $7,400 per year. Now that's real money we're talking about. When the numbers get bigger, it feels a lot better. It feels a lot more meaningful than if that was $7 instead of $7,000. And it just buys more. Like, it's more impactful in your life to have that kind of return than it is to have a small return. But the only way you get there is by putting in a bunch of money upfront as early as you can, giving it the most possible time to grow, and then it starts to be like life-changing. As promised, here's that IRA video. And then if you want kind of a more in-depth version of the same video that we just talked about today, here's a video that's basically, if I started over investing today, had to completely redo everything, let's chat about it for an hour on the couch. That's all right here. The secret comment word for today is smoke. Thank you everyone for watching and subscribing, and I'll see you guys next time. Bye.